The phone that you're holding in your hand, if you were to cast that in a gold bar, that will be at least 2 to 3 crores.
Yeah.
So you can imagine for 300 crores, you just need 100 of these phones, which you can probably store in a box, in a slightly bigger box. Anything less than 5% in your portfolio will not be of too much help if some black swan event happens. So the minimum amount most studies say is 5%. But it is a superior way of holding gold. So in terms of liquidity, in terms of safety, in terms of convenience, Gold BeES is far superior than the physical market. Gold is extremely valuable and it has got a higher density than aluminium, copper and steel, which means it takes a lot less space to store gold than, let's say, silver or platinum.
वेलकम टू धन्स पॉडकास्ट। आज हम बात करेंगे गोल्ड बीज के बारे में और उसके लिए हमारे साथ है विक्रम धवन जी। वेलकम विक्रम टू द पॉडकास्ट।
Thank you, Sandesh, for inviting me.
Thank you. So a lot of people want to know about gold bees and like I think आज हम काफ़ी क्लियरली सबको समझाएंगे कि गोल्ड बीज क्या होता है। Is it really better than physical gold? And we'll straight dive into it. But before that, I want to know more about your role in Nippon. What exactly do you do? So can you explain in brief?
Sure. Nippon India Mutual Fund is a fund which has got a comprehensive set of products. We have debt, equity, commodities, and in fact, in commodities, we are one of the leading, if not the leading, AMCs in the industry. And I head the commodity vertical, and in commodity vertical, we have, the main products that we have right now is the Gold BeES or the Gold ETF. Then we have Silver ETF or Silver BeES. Then we have the Gold Saving Funds, Silver Fair Saving Funds. And we also have a multi-asset fund which invests into commodities. So this is what comes under the commodity vertical. So I've been with the organization for a fairly long time. And I think the organization is fairly committed to the commodity space in India.
So for someone who has never bought gold bees, can you explain in simple terms what gold bees is and how is it different from buying physical gold or jewelry?
So Gold BeES or Gold ETF, as they are called globally, were, I would say, invented sometime in the early 2004 or 2005. And we had launched the Gold ETF in India in 2007. As far as the financial innovations of this century are concerned, Gold and Silver ETF are perhaps one of the most innovative products that has been invented in the financial space globally. Why? Because in a Gold ETF, there are a lot of advantages. First of all, it is regulated, unlike physical gold. Secondly, the liquidity. The liquidity in the gold and silver ETF is significantly better than the physical market. And most importantly, it is within the ecosystem of mutual funds, which means the investors get all the benefits which come with within the mutual fund ecosystem, whether it is taxation or whether it is SEBI regulations or whether it is the other factors which provide safety to the investors. Because mutual fund industry in India is more focused towards protecting the investors. Yes, there is innovation also, but the mandate of the mutual fund is for the betterment and for giving a better experience to the retail investors. Now, how the gold ETF works is gold ETFs are backed fully by physical gold. So all the gold which is held by Gold BeES, as per the SEBI regulation, has to be of the highest global standards, which is the LBMA Good Delivery Standard, as we call it. Now, LBMA Good Delivery is the London Bullion Market Association Good Delivery Standard, and they have prescribed the rules and regulations with regards to the purity, to the weights, and the tolerances in these two. In the Indian context, the gold ETFs are fully physical backed as per the SEBI regulations. So, as you can see, that it is not just a proxy for physical gold, but it is a superior way of holding gold. Whenever you buy a unit of any gold ETF, whether it is Gold BeES or any of the other gold ETFs, they are fully backed by physical gold of the highest quality. So in terms of liquidity, in terms of safety, in terms of convenience, Gold BeES is far superior than the physical market.
So you mentioned about the London bullion market, LBMA. Is there an Indian bullion market also? Also, what's the difference between the size of London market and the Indian market?
So today, roughly 90-95% of the physical trade which happens, it uses the LBMA benchmark and the rules and regulations. So it is something which has been there for a very long time. Yes, the Indian markets, as of now, we don't have a spot exchange in India. But I think in time, in years to come, the Indian bullion market will also develop. I think the fact of the matter is that today, we have to, whatever products we are offering, whether it is in debt, equity, or commodities, to the investors in India, we need to ensure that they are, of global standards. So whilst there is no discrimination against the bars locally available, but I think since 90-95% of the world adheres to the LBMA standards, I mean, that is something which also the regulator is also prescribed for us. So for the time being, I think this is what will continue.
So I think Nippon's gold ETF has been there since 2007. Like, correct me if I'm wrong.
Yes.
So it's like almost 18 years. So what motivated you guys like to start it long back? And like how has investor confidence evolved over the 18 years? How people were investing in 2007 versus how people are investing right now. So
So there were 2-3 factors which motivated us to launch the Gold ETF Gold BeES way back in 2007. First of all, India is one of the largest, rather the second largest consumer of gold. It's only next to China. In fact, at that time it was the largest. Now China has taken over in the past few years. So there was a gold market which was there. Secondly, what we observed was that the gold ETFs provided a superior liquidity. Just to give an example, when you buy 1 gram of physical gold and if you sell it immediately, the impact cost or the buying selling spread can be very large. Whereas in case of ETFs, on a single day, you can sell the ETF unit, buy, sell, do as many transactions. The spread or the impact cost is very narrow. Secondly, when you are having any physical gold, if there is any complaint on that gold, there is no platform, there is no regulator to take care of that complaint. Maybe if it's a big issue, you will have to go to court or police station or whatever it is, because after all, gold is money. But in case of gold ETF, in case of any mutual fund, now that the market has matured and we have seen so much of events and activity happening in the past 20-30 years, most of the investor complaints are actually sorted out by the existing regulations. So I would say 99.9% investor complaints which come out, SEBI already has the process, the SOP in place how to dispose of these complaints. You don't have to go to a police station, you don't have to go to a court, it is pretty much there. So I think one of the reasons why people should appreciate a regulated product is because once a product gets regulated, the investors are protected by the regulator, which is not the case with the physical gold. So I think safety was there, liquidity was there, and the market was there over here. But again, at that point of time, there was aversion by the investors to invest in any sort of gold which was not physical. The main market or the main demand in India was either jewelry or bars or coins. But over the years, what we have seen is that investors have realized and specifically those investors which believe in wealth creation through capital markets, those investors who don't want to take up the hassle of storing physical gold, those investors which want the protection of a regulator, all these investors have started now migrating to gold ETF because at the end of the day, if you are an investor, then it is not just the absolute returns that you make on your portfolio. It is the risk-weighted returns that really matters. So gold plays the part of a portfolio diversifier, as you can say, or a hedge. Anyway, gold is anyway a hedge against all sort of calamities, financial, geopolitical. So I think there is a section of investors and physical buyers which have now in the past few years started migrating to gold ETF. But again, it is still a trickle because even now 92% of the gold consumption is in physical form, which tells us two things: that the upside for this product is pretty huge. We have just started. And secondly, I think the way things are going and the way Indian investors and Indian public become more aware about stock market, about investments and wealth creation, I think I would say we are probably at an inflection point where now in the coming years and decades, we will really see an explosion of interest from the investors into gold ETF.
Got it. I think one question which strikes my mind is that there must be some underlying depository of gold over which the ETFs are running. Who holds this depository? Like, does AMCs hold it, SEBI holds it, or RBI holds it, or like it's with the LBMA or something?
So mutual funds or ETFs by structure are a trust. So, and in a trust, what happens is that there is a custodian. As per the SEBI regulation, there is the AMC, which is the interface between the investors for creation, redemption, buying, selling of the units. Then, as per the SEBI regulation, there is a custodian who is responsible for the safekeeping of the gold bars, even the accounting and everything. Everything they take care of it. India is unique in one part, that globally only the AMCs are regulated. Most of the markets, only the AMCs are regulated. Custodians are not regulated. But in India, both the AMC and the custodian are regulated. So there is a double safety feature in this. Whilst the custodian is responsible for the safekeeping of gold, but we are also a trustee. We are a trust. So as a trustee, we also have a responsibility. So it is a dual responsibility that we have as per the SEBI regulations. And all the gold which is held, again as per the SEBI regulations, has to be held in the geographical boundaries of India. And as I mentioned, in India, gold ETFs are fully backed by physical gold.
We'll go to the next question. So gold BeES represent 0.01 gram of gold. If an investor starts investing, how can we start from a very small amount, and how does he invest? What should be the minimum amount of investing ideally?
So again, the beauty of the product is that today you can invest as little as 100 rupees in the gold BeES or gold ETFs, which is the smallest amount. There's no upside to it. I mean, you can buy as much gold as you want. Now it is very important what is the objective of the investor. Is she or he buying gold for purely as a replacement for physical gold, or they are buying it for portfolio diversification of their existing investments, or they are simply buying gold as an insurance? So it depends what is the motivation, what is the objective of buying gold BeES. Now, for somebody who's buying gold BeES purely as a replacement for physical gold, then obviously they will know how much gold they want to buy. It may not be in percentage term. They would know, I want to buy gold worth this much amount in Diwali, or this much in Dhanteras, whatever. This is something which they would have more like a budgetary thing, as and not more so much as an analytical thing. Now, in the second case, for investors who have invested in the capital markets, they are buying gold ETF, gold BeES for the purpose of portfolio diversification, portfolio hedging. In that case, there are various studies which have been done. There was a study which was done by World Gold Council. There are various studies which are available on the internet. But one thing which is common for all the studies is that anything less than 5% in your portfolio will not be of too much help if some black swan event happens. Like prior to COVID, if you had 1% gold, or prior to the great financial crisis, you had only 1 or 2%, that would have not saved your portfolio. So the minimum amount most studies say is 5%. Now, it can be 4%, it can be 6%, 7%. There is no line in sand which says that. But this is roughly the minimum amount. As far as maximum is concerned, various studies have been done by various agencies, and they have said that 15% should be the max. Because as per the classical portfolio theory, if you go beyond 10, 15%, 10, 20% of a single asset in your portfolio, then it leads to concentration risk. Then your portfolio gets pretty much affected by what is happening to that particular asset class. So I think 5 to 15% is the range which most studies have suggested. Also, the most interesting part is that what is the structure of your portfolio? Are you heavily skewed towards risky assets, or you are heavily skewed towards risk-free assets? For instance, if your portfolio is primarily high beta stocks, then you would need higher gold allocations. But if your portfolio is skewed towards more fixed income, fixed deposit, whatever, then you will need gold, because obviously, it's going to be, it will take a very, very massive black swan event for the banks and the fixed income to, blow up. That kind of event will be, we'll have other things to worry than about our portfolio if something like this is happening. So I think if your portfolio is pretty much risk-free, there's nothing known as risk-free, but of less risk, like fixed income, etc., then I think you may, if it is for a hedge, then you should be on the lower band. But again, as gold has given returns more than fixed income in the past 20 years, then obviously you may also use gold in that case to enhance the overall returns going ahead. So I think this is, in a very brief, in a very basic way, this is a few points which the investors need to keep in mind.
I think ये काफ़ी ज़रूरी चीज़ है, क्योंकि काफ़ी लोगों को पता नहीं है कि कैसे गोल्ड को hedge के तरह यूज़ करके you can like make your portfolio more efficient, I feel. So my next question is, what's the expense ratio of your fund, say Gold BeES, and also over the past say 18 years, your fund has given an average of around 12.6% returns, and gold benchmark has given 13.5 or around that much returns. So why there is a difference of around 1% there, and like what's the reason behind it?
So I think let me clarify one thing, that expense ratio is not an important part of a gold ETF. Let me give you an example. Today, if you see the global markets, the top 2 gold ETFs in the world have lot higher expense ratios than the ETFs which are below that. Now, why that happens is because in ETF, specifically gold ETF, liquidity is very important, because you should be able to get in and get out of the product. See, why we buy gold? Because gold is fungible to cash. Gold is the most liquid, after currency, gold is the most liquid asset class, right? So, and this is everywhere in the world. So, every investor would not want to buy gold in any form which is not liquid. Just to give you an example, like sovereign gold bond were fantastic, product, but they were not liquid. I mean, if you wanted money immediately, they were not available, or they were not a hedge against a geopolitical or a financial crisis. So again, the volumes, the AUMs, gravitate towards liquid. So investors have to see which are the most liquid funds in a particular market, and you can see the data at the National Stock Exchange, because all the gold ETFs in India are listed and traded on the National Stock Exchange. Just see which are the most liquid. How it will help is because while you are buying or selling, typically what happens is that whenever there is high volatility, whether like for instance today there is a lot of interest in gold, so this leading to a lot of volatility in gold. It keeps on going up, then small corrections keep on going up. Or you have interest in gold when there is a geopolitical event, right? When again it becomes volatile. So what you have to see is that typically there could be instances, more often than not, when you will be wanting to buy or sell gold when the market is very volatile. Now, in a volatile market, if the counter is not liquid, you can lose a lot more than the expense ratios. Because if you're not able to, and especially larger the size, so I think I would say expense ratio is something which is not something to be considered about. Now, with regards to the difference between the spot prices and the ETF returns, let me explain to you. The spot prices calculated are theoretical prices. There is no spot market in India. See, today when you talk about Nifty, there is a spot market. Today you say 1 year Nifty returns is X%, right? It is not a theoretical price. It is there on the NSE that 1 year back Nifty closed at this price and today it has closed at this price. So this is a 1 year return. This is not the case in gold. There is no spot exchange. So this is something which has been calculated that, this is the landed price of gold. This is the duty, this is the custom rate, this is the GST, this is the exchange rate. So you have put a theoretical price. I would put it the other way. In the absence of a physical market, spot market in India, gold ETF becomes the spot market, isn't it? Because there is no, where in a regulated environment you are buying and selling spot gold? Nowhere. It is just because ETF is nothing but it's a fully backed gold instrument. So I think comparison with the prices in India is interesting, but let me tell you that is a theoretical price because nobody traded that price. Whereas in case of ETF, you can see where gold BeES closed 1 year back, where it is closing today, and you can calculate the returns. And this is a real return. This is not something which is theoretical or it is derived. But that is, so I won't worry too much about till the time we don't have a spot exchange in India, I think this is something which this question will always crop up.
Is there a possibility that going forward there might be a spot exchange or something? Like,
so you see, spot exchanges in the world have been, successful in only two countries, two regions rather. One is London, obviously, LBMA is a spot market, but that caters to the entire world. And then Shanghai. So while spot exchanges are needed, but they are not very easy to get the volumes and the critical mass which is needed. Why? Because obviously the world has been hooked on to these LBMA for a very long time. So to get them, de-addicted and bring them to, it may take time. But yes, I remain hopeful. Why shouldn't India have a spot market? I mean, we are the second largest consumer in the world. It should have already been there. If you really ask me, the spot market in India should have already been there. Why it is not there? That is a question which I am also asking like you.
okay. So we talked a lot about liquidity. How is the liquidity increasing in Indian markets right now? And how do we compare it with, say, US market or UK markets?
The kind of volumes and liquidity we saw in 2023, in 2024, it was 3 to 4 times of that. Now, after having gone up by 3 to 4 times in 2024, in 2025, we are still, some months to go. In fact, we are halfway through the financial year. So let's see what happens. But so far, even compared to 2024, the flows and the volumes have gone up by at least 2 to 3 times. So this is a market which is growing in an exponential terms. Now, comparison to the US market or London market or the Shanghai market is slightly different. Why I must tell you is because these markets have been there for a very long time. London has been there for 100 odd years. New York has been there again 50, 100, I don't know how many years, but these are like many, many decades old. Even Shanghai market is also 1 or 2 decade old. So, so I think we will take time, but I think the way this exponential growth is going, I won't be surprised that at least in the next 3 to 5 years, the kind of volumes that we will have, uh, the exchange volumes that we will have on gold and even silver, maybe if not matching London or New York, at least equal or better than Shanghai.
Okay.
But it will take some time.
We'll dive into the next question. Recently, gold का price काफी बढ़ गया है. It's over like 1,15,000. So, how do you manage operationally storing and managing such large quantities of gold at such high prices? Also, another question is, it's just an add-on key. Due to such high prices, do you see a dip in, say, investing in gold BeES also? And how is it like performing right now?
So, I started my career 30 years back. That time, gold in dollar terms used to be $250 per ounce. Even that time, people used to say it's very expensive. People have said gold is expensive at 5,000 rupees, 50,000 rupees, 80,000 rupees. So, this is something which we all keep on hearing. And in fact, let me tell you that not many of your listeners may be aware. Gold is not only the best performing asset class in the past 1 or 2 years, it has been the best performing asset class of the century. So from 2000 to 2025, gold has been by far the best performing asset class. Even better than stock markets, even better than the stock market of US, which has got those, so-called Magnificent Seven or FANG, whatever you want, yeah, FANG or whatever you want to call that. So that really tells you, the trajectory of gold. So yes, unfortunately, gold, like a Ferrari or a Lamborghini, will never be cheap. This is something that's why it's called a precious metal. Now, with regards to story, see, one thing good about gold is that gold is extremely valuable, and it has got a higher density than aluminium, copper, and steel, which means it takes a lot less space to store gold than, let's say, silver or platinum. So it's pretty, I mean, just to give an example, the phone that you're holding in your hand, now if you were to cast that in a gold bar, that will be at least 2 to 3 crores.
Yeah.
So you can imagine for 300 crores, you just need 100 of these phones, which you can probably store in a box, in a slightly bigger box. So that gives you an idea that storage is not a problem as far as gold is concerned, because the per square feet value is very, very high. But yes, one thing I like to add over here is that it is fully insured completely, and there are not only insurance, but it's under constant audits and inspections, and most importantly, uh, you know, the there is global guidelines on how to store gold. So you can't just store gold in any vault. The thickness of the wall, the kind of security you need, the kind of electronic gadgetry you need. So, every gold vault is no less than Fort Knox, I would like to say.
So the next question is, I was going through the product page of the scheme Gold BeES. So it is listed under a high risk in the riskometer. So usually gold is known for being a safe haven. On the riskometer, why is it say put it at high risk? First question. Second is, there is no exit load on Gold BeES, and there is no securities transaction tax also. So why is it so? What's the reason behind it?
So I think the way the regulations work, there are too many criteria for sort of categorizing a fund or a asset class as far as the riskometer is concerned. I presume when these products were started way back in 2007, they were fairly new, and obviously at that time gold was a lot more volatile and less, accepted or appreciated or embraced by the investors as it is being done now. So yes, maybe perhaps it is a slightly dated, risk categorization. Maybe it needs to be revisited. Now, whether this riskometer has affected the investor appetite, not really. Why? Because first of all, the Indians understand gold and silver much better than anybody in the world. Slightly digressing from what you asked, post-COVID, 2020-21, a lot of the international investors started selling gold, and lot of money came out of gold ETF. So much so that roughly about 800 tons to 1,000 tons of AUM came out of the global ETF. But in India, the flows actually started, they bottomed out then, and they started rising. So I would say Indian investors are one of the very few investors in the world who have, especially the ones in ETF, Gold ETF, Gold BeES, whatever you want to say, they have ridden the entire bull market, right from gold going to 40, 45, 50,000 to 1 lakh 10, whatever. They have entirely ridden the. So I think, as a fund manager, my job is very difficult to teach something new about gold to the Indians, because many of them would understand gold from generations. Yeah. And sometimes, more often it happens, their conviction is a lot more than my conviction when I'm speaking to them about gold. So I think gold is above the board as far as categorization and the risk profile, etc., is concerned. And it's got a special place in India, and that's why we hold roughly about $3 trillion worth of gold. And just imagine what gold has done to the household wealth. Gold is up by about 50% in the past 1 year. So you can imagine that how much of net worth it has added to households. Even if on a conservative basis we were holding $2 trillion worth of gold, so in past 1 year it has added about $1 trillion in household wealth.
I think RBI is also increasing its gold deposits a lot.
Yes, absolutely. Yes. RBI and the central banks across the world have been large buyers of gold in the past 3 years. Wow. So I think it is something, I always tell investors that gold has a track record of thousands of years. No stock, no fund manager, no exchange has got that much of a, track history. So, and as I mentioned that this century, it has been the best performing asset class. So, again, let me, caution your investors not to get sucked in by FOMO or momentum or whatever it is. It doesn't mean that something has given 50% return this year will give the same return next year. Markets go through cycles. But yeah, gold's track record is very difficult to ignore.
I think it's very important for investors to stay in for long term. It's more about market cycles. Like we have seen a market cycle already. Then maybe after a few years, we'll again see a market cycle where we'll see again so much rise in gold prices or maybe equity also. So I think it's about staying in for a long time rather than expecting a say 50% return over a year or something. That's more important.
Sure, absolutely. And when you go with a multi-asset approach, you have debt, equity, and gold in your portfolio. What it does is that no matter what happens, at least one asset class is performing. Secondly, what happens is, suppose, nobody predicted COVID. Nobody predicted the great financial crisis. Nobody predicted the Ukraine war. I mean, obviously, in hindsight, everything looks easy that, this should have been predicted. But we don't know when the next crisis, where the next crisis is coming from, when it's going to come from. Whenever that comes, if you don't have a hedge or a diversifier in your portfolio, and gold is one of the best, because what happens is, if you start buying gold just when the geopolitical or a financial crisis happened, then you will end up buying it at a very expensive price. Whereas if you're buying throughout as a discipline that, I need to have X% allocation to gold in my portfolio, come what may, whether it is a bull market, bear market, whether equities are doing well or not, I will keep it a minimum of this. So whenever that event comes, your this thing is protected. It's like an insurance policy. Yeah. You don't buy an insurance policy just because you have an accident or you want to have an illness, but you need an insurance policy, and you buy it when the sun is shining, not when the then you're already ill or you already met with an accident. So that's the analogy which is very important for the investors.
I feel ki if you have some amount of gold in your portfolio, you can take risk in other assets a lot. Say if you have 10% gold, you can go with her 10% small cap allocation or something. So I think that sums up.
Yes. Also, one more important thing with gold ETF is that today, since gold is such an important part of our culture, there is a bit of a stigma attached to, people selling their gold. So, it's like even in family and friend circle, if you know that, somebody is selling physical gold, the question is why? Is something wrong? Well, they may be selling it to buy a house or somebody's education or somebody's marriage, but that anonymity you get in gold ETF. So I think culturally ETF sits very well for two reasons. First of all, you can buy and sell as much amount of gold on the exchange. Nobody comes to know about it. And secondly, you can even take profits also. I mean, today, if you have all your gold in jewelry form, it's very difficult to convert that into cash, it is to be molten and it is to be went to a jeweler, and there's a impact cost involved, there is a making charges, melting charges. By the time, you get the money, 10-20% already you've lost in that. Whereas in case of gold ETF, let's say you have decided to keep X% and suddenly the market is doubled, you have got 2X gold in your portfolio, go and take some profit. I mean, nobody in your friend circle will come to know that you have sold gold today.
And there's no exit load also. So
no exit load in that, yes. And even taxation also, the gold ETF taxation, after 1 year holding, they're eligible for LTCG. Okay. And for gold savings funds, they are eligible for LTCG after 2 years of holding. Same for silver.
I'll come to the last question. We talked a lot about geopolitical tensions. What a lot of people, they try to do is they try to correlate gold with other products. Say they try to correlate gold with Nifty or say stock market. Some people try to correlate it with crude, some with US dollar. They say that if gold is rising, stock market will fall. Some will say crude is rising, this will happen. So is it correct to correlate gold with other products? Also, like, is it really like, does it make sense like doing this?
In the short term, yes, because what happens is in the short term, the markets are affected by flows. So obviously, people tend to chase whatever is doing well. So it may happen that suddenly, equity starts doing well, then the flows may be diverted to equities. Fixed income starts doing well. Now what is happening in gold is doing well, we're getting flows in gold. So this short-term phenomena will always happen. To that extent, when I say short-term, maybe 3 to 6 months kind of scenario, you might see these correlations on the ratios. But I think in the longer term, it doesn't matter, because in the longer term, the markets evolve, the economies evolve, the factors change. Whatever may be driving the market today, not all those 5-10 factors will be there tomorrow. So I think it keeps on evolving. So that's why on a longer term basis, while it is a very, very good theoretical analysis, but can you use it to make money? Not all the time.
Okay. So one question which comes into my mind is, say if I'm buying gold ETF or something, when I buy, say, any quantity of gold ETF, does it mean that I'm directly buying gold? Also, what's the role of a fund manager in this? Like when I click on a buy button in an app or something, uh, does it go to a fund manager and then he buys in like after some period of time, or like I instantly buy the gold, or like if it happens after a period of time or something?
So the way ETF work is that ETFs are exchange traded fund, which means that they are listed on the exchange. Unlike a normal mutual fund, which is not listed on the exchange. In normal mutual fund, you have to come directly to the fund for either subscription or redemption. But in case of ETFs, you have to go to the exchange. Now, what happens is that the liquidity in the ETF, gold ETF, is provided by market makers. Now, the role of the market maker is that suppose if there is lot of buying coming in the counter. So again, buying an ETF is like buying any other stock in the stock exchange. National Stock Exchange is obviously the place where it is the volume is a lot higher. So let's say you want to buy 1 unit of Gold BeES. You tell your broker to buy 1 unit of Gold BeES. So what happens is that once there is sufficient buying coming into the market, then the market makers approach the fund house to create units, because investors cannot directly come to the ETF. As per SEBI regulations, only if you have a ticket size of more than 25 crores, only then you can come directly to the fund house. Otherwise, you have to go through the exchanges. So this keeps on happening on an ongoing basis every day. You will have creation, redemption, depending upon the flows happening in the market. The role of the fund house and the fund manager is to, first of all, to ensure that all the SEBI rules and regulations are maintained, whether in terms of how much gold is to be held, what is the maximum cash you can hold, the type of gold to be held. Also, when we are buying and selling gold in the market for adjusting the cash, we have to ensure that we are getting the best price possible for our investors. So it is more of a regulatory compliance, more of a cash management, inventory management. That is something, risk management, most importantly. This is what is the role of the fund manager.
Got it. Thank you so much, sir. I think a lot of users will have clarity after this, ki if they should invest in gold BeES or ETF or not. Is physical gold better than gold ETF or not? There were a lot of doubts between the investors. I think they were scared about liquidity in gold ETF. So I think this must be clear now. So thank you so much.
Thank you very much for inviting me on your show, Sandesh. Thank you very much.
My pleasure. Thank you.
Investments in the securities market are subject to market risk. Read all the related documents carefully before investing.